Kimberly-Clark has reported its earnings today and is down more than 4%, sitting towards its 52-week lows. Is it a buy now for this very strong long-term company? We're going to take a look at the historical performance. We'll see how their top line revenue as well as their bottom line net income has grown year on year. We'll take a quick look at the health of this company, total cash versus total debt. We'll also compare their performance over the last 5 years versus some well-known competitors. And we want to see what are the institutions doing. Are they buying or selling this company? As well as insiders, we do note some insider selling, so we'll touch upon that. And we'll take a look at their dividend safety, looking through their financial metrics. And we will have a look in detail as what's going on with their earnings that they did report. And finally, we'll run them through our valuation model, getting to our intrinsic value, finding our acceptable buy price, given that investor margin of safety, and see what Wall Street are forecasting for KMB over the next 12 months. So let's jump into their earnings, and we can see on the headline they did miss by 3 cents on the earnings per share. However, revenue did top analyst estimates. So when we take a further look, we can see that they reported their fourth quarter earnings per share 151. Analysts had expected 154, so they did miss. That was a shame. And we do note their revenue of $5 billion did come up slightly higher than analyst estimates of $4.99 billion. So let's take a look at this company. Now, over the last year, it is down 11%. Bear in mind, this doesn't include those dividends reinvested. Pretty much at 52-week lows, offers a forward yield just under 4% and a forward PE just under 19. Now, if you've been holding this company over the last 10 years, it has been very rocky, but it is up around 15%, and we can see its all-time high sitting at around $158. So let's take a look at their top line revenue. Now, what we like to see is 3 to 7% growth year on year. 18.5 billion reported in December 2018. December 2022, 20.2 billion. So we can see there's been 10% growth over the last 5 years, which in all honesty isn't that great. We want to see around 3 to 7% year on year. And we can see 2018 to 2019, their revenue remained flat before increasing into 2020, although marginally, with another marginal increase in 21 and 22. And we are expecting that full December 2023 to be another marginal increase. So yes, their top line has increased over the last 5 to 6 years, but we can see very small increases, and we will touch upon that when we look at the metrics and look at their percentage form over the last 10 years. Bottom line, well, 1.4 billion in 2018, 1.93 billion in 22, so it has increased over the last 5 years. We are expecting a drop once their December 23 full annual report comes out. And we can see on a more granular level, their bottom line did increase to 2020 before dropping and then picking up again and expected to drop. So there are real inconsistencies on both their top line and bottom line. Even though they are increasing, it is something that we will consider shortly. So total cash versus total debt, a quick health check. 539 million reported in cash and short-term investments. Latest quarterly report, 840 million. So they are holding on to more cash than they did 5 years ago. Numerically and directionally, let's have a quick look at their total debt. It has increased, but again, marginally, 7.5 billion to 8.3 billion. So both cash and total debt have increased, not to a great degree, so that isn't a massive worry, but we will analyse the net debt to EBITDA metric and that dividend safety shortly. So household products, we've got a few big names here: Church & Dwight, Clorox Company, Colgate, and a few others that are very well known. Over the last year, including dividends reinvested, Kimberly-Clark is the worst performing, down 7%. Now, when we extend that to the last 5 years, we can in actual fact see it is one of the middle performers, but still only up a mediocre 27.5%. But as always, it is very important to understand past performance isn't an indicator for future performance, but we do take a look at it as one level of our investment piece. Institutional ownership, well, it sits at 74%, as we can see here. 2.5 billion worth of sales by these institutions over the last 12 months. During the same period, well, a lot more buying, in fact, more than 3 times, or in fact, just around 3 times at 6 billion. So institutions are buying a lot more than selling. And what is interesting, if you go back all the way to pretty much Q3 of 2021, every single quarter, we can see more buying than selling by these institutions. So Kimberly-Clark is definitely, in my opinion, based on this data, an institutional favorite. So let's take a look at insider selling, insider buying. So we filtered for Kimberly-Clark at least 100 shares within the last 3 months. And we can see sales by 2 different members, one chief legal officer and one chief digital and technology officer. What's interesting to note, they did sell around the same amount of shares, although 1 month away from each other. And in total, this was around $750,000, or in fact, yes, $750,000, or just under. Now remember, with insider selling, it isn't necessarily bearish due to the fact that insiders sell for many reasons, whether that's personal reasons or they need the money, financial reasons. What we really want to see is bullish signal, which is insider buying, which we haven't seen on today's episode of Kimberly-Clark Insider Movement. So let's take a look at dividend safety. Now it has a score of 88. It is very safe. We can see market cap 42 billion. It is a large cap company. Now for those that see a recession inbound in 2024, these are the recessionary metrics. We can see here that they increased their dividend during the last recession above average growth, so negative 4%. As we can see, the average growth of companies in the S&P was negative 12%. And they also outperformed the S&P 500 with a negative 34% return versus the S&P's negative 55%. Dividend growth, well, very mediocre in my opinion, 1.7% in January 2023, 4% over the last 5 years, 7% over the last 20 years. Realistically, you want to see at least 4% just to keep up in line with inflation. As we always say, if you're getting less, you are losing your purchasing power and you are taking a pay cut. In better news, they are a dividend king. They have increased that dividends for 50 years or more. And in fact, they have paid a dividend for the last 88 years without a reduction. Now, dividend yield theory, we can see that sign of undervaluation. For those that are new, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average, 4.06 versus 3.39. Another sign of undervaluation with the forward P 17 versus the 5-year average of 19. And we can see here consumer staples is sitting higher at 19.4 at the sector PE. Do bear in mind though, we don't look at any of these models in isolation and we will draw conclusions towards the end. Regular viewers probably sick and tired of hearing it, but for the new viewers, earnings data we ignore. It is susceptible to manipulation by management through accounting. Free cash flow payout is the only data we look at, and we have run through examples as to why this is the case. Very quickly, we'll show you 2015, 61% earnings payout. You would be happy as an investor, whereas in 2015, if you'd seen the free cash flow data, you would have noticed here that they paid out, or management paid out more in dividends than they generated in free cash flow. 2022, a bit high for my preference. I would go up to 70% for consumer staples. On a more positive note, 2023, it is expected to come down to 62%. 2024, around that 70%. So this would be a certain red flag indicator. It is positive that it has started to come down in 2023 and 2024. Free cash flow per share, this is all about knowing and understanding the companies you invest in. We can see the free cash flow pretty much flat over the last 5 years. We do have years where it increases, years where it decreases. Very inconsistent, and we can see 2023 increasing expectations with 2024 going lower. So always understand you might be investing in a mature company, completely fine. You might be investing in a tech company, but important to understand what you are looking out for these companies. Sales growth, this is what I was trying to say. You want steady, moderate growth at the bare minimum 3 to 7% just to keep up in line with inflation. 2020, 2022 was their best year over the last 10 years. Just something to think about. 2023 expected 1%. Now, regular viewers, I'm not really going to go through this information in detail, but you should understand what I think about this based on the previous companies we have been through. Total sales, well, 20 billion to 20 billion over the last 10 years. I would like to say this is more positive. They do share buybacks. They do return excess cash to shareholders. But it hasn't really gone that far. It's 387 million shares outstanding. In 2023, 339. They've bought back approximately 10% of their shares. It is a bonus, I guess. ROIC, personally, I wouldn't touch any company that doesn't have at least 10% as a minimum on these metrics. The reason for this, when I look at management, it is effectively a tick next to their name when I see that they are effectively allocating their capital. So I need to see 10% or more. Kimberly-Clark, very nice, consistently very strong numbers. 2023 at 31%. That is a nice, big, juicy tick for me. Operating margin, free cash flow margin, it does straddle around that 16%. So it is something that is consistent with this company. So it's not a massive worry for me. 14% in 2023. Free cash flow margin pretty consistently above the minimum of 7%. So that is a nice positive. With 2023's 13%, that is nice to note. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization shows us two things. One, the dividend safety, and two, the balance sheet strength. The fact that in 2022, it would take the company 2.36 years to pay off all of their debt net of cash on hand, and is expected to go below 2 in 2023, with 4 being our maximum, is a positive sign of their balance sheet, and we do see why that score of 88 shows that the dividend is very safe. Now let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Now before we do just jump in to the valuation, just to let you know, we have just dropped the most recent newsletter. It's completely free if you want to sign up in the pinned comment below. We ran through our 7 golden dividend metrics that we look for undervalued companies. So if you do want to sign up, click on that free comment below. We're also doing a lot more newsletters every Sunday. Next topic will be on some very strong undervalued dividend growth companies. So let's jump into Kimberly-Clark's valuation. The first one, Graham's formula. We have the stock ticker symbol, the essential earnings per share, long-term growth rate, AAA corporate bond yield, to get an intrinsic value of $93. Now, this is a first sign of overvaluation. Do bear in mind, though, we're not looking at any of these models in isolation, and we will draw conclusions towards the end. We then have the multiples valuation model. We have those companies in a similar sector and size, their average P multiplied by the earnings per share of Kimberly-Clark, to get an intrinsic value showing undervaluation at $177. We then move on to the dividend discount model, now pretty much increasing very slow at 3.4%. Forward looking, we may have gone a little bit more optimistic at around 4%. We would like to see them at least keeping up in line with inflation. This gives an intrinsic value marginally above the market value, so therefore we do see that undervaluation signal. We then move on to the DCF model, where we have the free cash flows year on year. Average growth rate at 4%, forward looking, analysts estimating 10%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get an intrinsic value showing a third sign of undervaluation. Now, the intrinsic value here is just the average of these 4 models that we've gone to for today. And in the episode, the intrinsic value for Kimberly-Clark is $137. Don't forget, you can click on that pinned comment below if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list. So as always, we use a margin of safety of 10% if we believe it has a wide moat, strong financial metrics, good forward-looking data. We can see here it's a 10% margin of safety up to $123. At 15%, it isn't too far off, so we believe it has around a 10 to 15% margin of safety. Now, my overall opinions, for me, Kimberly-Clark isn't one that I will invest in. There's nothing wrong with it or anything that really stands out. But in terms of the metrics, there is a lot more or a lot to be desired, in my opinion. So it is one that I will be taking a look at only if we see a very significant margin of safety at around 25 to 30%. So we can see around that $100 mark. Right now, though, it is offering around a 10 to 15% margin of safety. Wall Street see upside of 15% over the next 12 months, so they see a price target of $138. As always, let me know your thoughts in the comments below. Is Kimberly-Clark one you are picking up towards its 52-week lows, or for the same reasons, are you not looking to add this to your portfolio? As always, let me know. Have a great day. Smash that like button if you've enjoyed today's content. Hit that subscribe and bell button, and I'll see you all on the next one.